And we very much welcome Brent Kochuba. And I'm just going to hand the meeting over to him.
Cool. Thank you again. I'm not sure how many of you all know who I am or SpotGamma, and I don't certainly expect anyone to know, but I'll just give you a brief background on myself and sort of what it is that we do. I have about 20 years, the time is really flying here, of institutional experience. So I worked for a few banks, Credit Suisse and Bank of America. I was in equities and equity derivatives as a sales trader. And then I worked for Wolverine, which is a big options market maker. I was a broker there for a number of years. And then I transitioned to a family office where I worked on options strategies. I worked for a portfolio manager who specifically traded S&P options for a wealthy family. And that unfortunately ended in the pandemic. I shouldn't say unfortunately, because I took all of those models that I built for the family office, and those are the models that run SpotGamma. So what SpotGamma does is I analyze the options market every single day, and I write a fairly comprehensive overview of what the options positioning is telling us. And I primarily focus on the S&P and the NASDAQ in that daily note. And then we have a bunch of tools and analytics and things like that that you can also see. I will say what we endeavor in, or sort of what our specialty is we've coined this phrase positional analysis. And if you think about technical analysis, we're all familiar with that, and we're all familiar with the fundamental analysis, right? But positional analysis, what it does is it looks at, or we attempt to look at, how the movement or hedging flows or market flows from traders' positions will impact the market. So, I think that there's a number of different things that can fall into this classification. Nowadays, when you start to think about margin calls, for example, with all the craziness going on, that could be some kind of positional analysis, right? How many people may be about to get called on a gilt position gone wrong. But from our perspective, what we are measuring is specifically options market makers and dealers hedging flows. And we try to calculate and estimate how the hedging impact of all the options positions in the U.S. options market may influence the underlying stock market. And so, that is essentially what we do. And I heard the tail end of your presentation here. So I'm going to operate on the assumption that everyone has a basic understanding of what delta and gamma is. If you do feel like you get lost, please, if you want to put it in the chat, or that's probably the most effective way, or if you just want to speak up and stop me, I'm happy to take questions. But I'm going to kind of roll through how I think this positional analysis and how options can impact the options market. So what I want to change the lens of how everyone is viewing the options risk and landscape here for a moment. If you talked about delta and gamma for your own positions, and you're trying to estimate how much P&L you may make right off a call position, or how should I structure a put position to hedge my portfolio, I kind of want you to put that lens aside for just a second here while we talk about options hedging. And on the screen here, I built this analogy of a stool or a chair, right? And the chair has four legs. And as you can see here, the legs to the stool are stock price, volatility. So when I talk about volatility, I'm talking about implied volatility. That's forward volatility. Said another way, what is the VIX doing, right? What are traders' expectations about what's going to happen in the future? Some people may think the market's going to move a lot, like around the FOMC or an election, or other times the market may be pretty sleepy, right? Time is the other variable, excuse me. Time is obviously kind of linear, right? It advances at the same rate constantly, but that affects how positions are priced and hedged. And then obviously the third one here, the fourth one rather, is rates. I don't focus on rates much in the work that I do on the S&P 500 and the NASDAQ. If you monitor ROE at all, which is the option sensitivity to interest rates, even if the Fed raises rates like another 4 or 5%, there's not a huge impact to the options market in terms of this positional analysis, right? But it does matter if you are trading a dividend stock, or a stock that has a high locate, right, or high borrow fee for short selling. So you do want to be aware of those rates when you're looking at maybe the hedging flow of a stock that's being heavily shorted. Okay, so these factors, if you imagine that I put a ball on top of that chair, right, and I was holding the chair in my hands, and I'm keeping the balance, that the stool balanced, right, and the ball's not going to roll off. As soon as one of these variables changes, right, one of the size of the legs shifts, right? Maybe the table leg grows longer, the chair leg grows longer, and suddenly I got to move quickly to rebalance. This idea of these variables always changing, right? And what hedging is trying to keep that chair balanced. And the way that you are able to keep that chair balanced, the primary way, at least in the short term, is to buy and sell shares of stock, right? Or buy and sell futures to keep that chair balanced. So when I talk about all of these different variables, all of these different variables that we may talk about, delta, gamma, vega, theta, right? All of those Greek variables are impacting the underlying options market, right? The options market and the hedge ratios of all of these different positions. So again, if you think about the balance of this stool and everything I'm about to talk about, all of the things that I talk about make this chair or this stool, it causes an imbalance in the way that you would hedge or adjust that imbalance, again, is to buy or sell stock. So that's sort of the framework that I want you to think of. Options dealers and market makers, their primary role is to collect spread. So what does that mean? They look to collect, the bid and offer, make a little bit on each trade that they do, but they then try to have a high transaction rate. In general, they're not there to say, I think the market's about to go up, so let's let our portfolio, right, or our book of options, let's expose it to positive deltas because we think the market's going to go up. That's not their role. So they want to keep that balance all the time. Okay, so we just came off of a very large options expiration. And the way that we measure the big options expirations, you can see a lot of people talk about how much gamma is tied to an options expiration, but we don't think you want to measure things in gamma when it comes to options expirations. You want to measure things in deltas when it comes to expirations. And if you're going to look at where the most obvious impact of the options market is on the underlying equities, you want to look in options expirations. And I'm going to lay out why I think that is. So we just came off of this very large options expiration on 9/16. And what you can see here is aggregate delta. So I look at open interest and I took the delta of every option open in the S&P 500 and the NASDAQ. So that's SPDRs, SPX, Qs, and the NDX. And I summed the call positions, right? That's what this dark navy blue bar is at the top. And at the bottom in teal is put positions. And what you can see is that at 9/16, there was a very large options expiration. Now, the quarterly expirations, those are the expirations that take place in March, June, September, and December. And when I say quarterlies, technically there's an expiration like on 9/30. That's officially the quarterly. But generally, I'm talking about the third Friday expiration of those quarter months. So this past September had a very, very large expiration. But what I want you to note is how much larger the put position is relative to the call position. So this market in 2022 is a put-heavy market. Almost the entire year has been dominated by put positions, opening and closing of put positions, which exacerbates volatility. I'm going to cover that in a little more depth as to why, but this is what is so interesting about this big expiration. So in theory, if you believe that most traders, right, own put positions to hedge their portfolio, when we had a situation like this wherein the market cascaded lower, right? After Jackson Hole, we just slid very sharply lower. And then there was that big CPI print, right? That had so much volatility associated with it that spun the market again lower into September options expiration. You have a lot of options deltas that are going to expire. And those deltas are primarily put positions. So if, Don and let's say, we got Mike on here and Lisa, if you guys are all long puts, dealers are short puts. And the way that they would hedge those short puts would be to sell futures and own possibly like deep out of the money options. But the core position is really to be short futures. So all of a sudden on 9/16, right, last Friday, these positions all expire, right? They're extraordinarily sensitive last week with that CPI reading, right? The gamma is very high of all these positions. Gamma is highest for options that are at the money and closest in date to expiration. So there's a lot of gamma sensitivity to these positions. I think there's a big reason why that CPI reading led to such a fast and wicked, 100+ point move down in the S&P in the matter of like 60 seconds, right? It's because all of this gamma was so high that for these positions that expired on 9/16. So again, all of these put positions expire and dealers are left sitting there holding a whole bunch of shorts, right? Short hedges that they no longer need. And then so what do? They got to cover those positions, right? They got to buy those positions back. They got to roll out of those short positions. So consequently, what we see is oftentimes there are very key turning points in the market related to these options expirations. Now, I've marked some of these expirations here. I have another chart where I actually marked basically every expiration going back for quite a while. And this is kind of the live chart, so to speak. But what you may notice is that if I flip back to this other chart, this was the June options expiration. There was a pop after FOMC. We sold back and then kind of bounced after June expiration. Around July, we had some more puts expire. The market kind of gapped up. Same thing in July. But then what you may notice here is that in August, there was the opposite sort of reaction, right? The market actually was at a high and it gapped lower after August expiration. August was the only month that we had actually, and the size was nowhere near kind of what we're talking about here, but it was the only month this year that we had net positive delta in the market, meaning call positions were larger than put positions. And what you may notice is that that is the only month this year that the actual market behavior was to gap down after August expiration. We obviously had Jackson Hole, and then we came in this very interesting expiration this past week where we did catch a bid really for a pretty small amount of time. The other interesting sort of dynamic here is that if I scroll this back a little bit, is that the options expirations tend to fall, the quarterlies tend to fall with the FOMCs right on top of them. So oftentimes you'll see the FOMC take place before the expiration. So you'll get this interesting change in implied volatility where usually the Fed doesn't upset the market too much. And so you'll have a general trend in implied volatility coming down. And then we'll get this big clearing of big put positions, which we believe can lead dealers to buy deltas back. So if you remember this analogy of the stool, right? In one position, we have all of these positions, being removed, right? This is kind of like almost a time-weighted thing. But implied volatility, if you want to put and implied volatility comes down, right, then that put is not worth as much money. So from a dealer's perspective, if they are short put options with short futures as their hedge, and suddenly those puts all lose value, they make money on the put side, and they no longer need to be as short in theory, right, on the future side, so they can buy futures back. So there's that variable of change. In this past expiration, because FOMC actually fell a few days after, and this is a very contentious FOMC, we think that actually kind of held implied volatility up here. So rather than a bounce in this situation, we actually got just a pretty quiet market over these 2 days. The market held up pretty well until FOMC, and then obviously we've drifted back pretty lower. And I'll give an update on some interesting positioning into that expiration. So, excuse me. So I want to drive home this idea a little bit further here. What you see on your screen here are the sum of the 5-day returns in the spiders, right? So I just look at the open to close performance every day, and I basically add that up. And what I marked on the chart here are the big options expirations that have occurred this year. And what you can see is there seems to be this pretty clear pattern, right? We have negative returns in January. January was actually one of the biggest options expirations I've ever seen. It was very interesting because it was very deep in the money call positions that all expired, and that led to a ton of volatility. And incidentally, if you look at the intraday high of the VIX, it was on the day after January options expiration. That coincided with the low of the market in January. So, we had that clear expiration here. The market performance returns positive, right? You see there's like a cycle or a wave here. Again, in this case, we had a very big FOMC in March. Chinese stimulus was announced as well, so the market caught a little bid before FOMC, before options expiration, and then we had another 5 to 10% return after options expiration in March. And again, there's another cycle here, and as you can see, there appears to be this pattern, right? So I want to be clear on one thing too. I don't believe that every market movement is driven by the options market. But I do think that there are times when the options market is so big, it is the key driver. So let's look at some actual data around this, right? This was actually published, I believe, in Reuters. This is on the Daily Shot. Sober Look is the Twitter handle that posted this. I have a Reuters chart as well. But what this shows you on the top is the average return into expiration Friday, and they bucket this by year. And if you look at this year, this is the performance of the S&P 500 into the third Friday of every month of this year. So if you look at that week, right, the week leading to options expiration, you can see how bad the return is, negative 1.8%. Conversely, if you look at the return after options expiration. Again, after these big expirations, one like we just had here, you can see the return is very, very positive, 2.3% positive return. Now, in the last few years, the return has been a little bit more negative, right? Again, certainly not as much volatility in the market, but it's the same general idea here, that you see lower volatility, but still negative returns into options expiration, and then lighter positive returns after expiration. Now, what's interesting about this is that obviously some of these data points can be skewed in terms of, there's a few expirations that really, swing some of these returns. But there is a Reuters article I thought I had in here that also catalogs these returns for this year. The one thing that I want to note about this year, right? Again, think back to my comment about how big the put positions were in the market. And I can show you guys and kind of quantify that a little bit. But the put positions are massive this year. And to your point, you guys were talking about gamma here, right? Well, if you're short puts, right? If you're dealers and you're primarily short puts, you have a short or negative gamma position. So how do you hedge negative gamma? You have to chase the market. If the market is selling off like it did today, dealers have to sell futures to keep up. If the market pivots and starts to rally, then dealers need to start buying futures, right, to chase, right, to continue. So they're always trading in the prevailing trend when they're in a negative gamma position, like they generally are when we have big put positions in the market. The other thing about this, the situation with the put positions, and if you think about that gamma chase, right, I've not seen a market that I've been doing this for where we've had such a complete sort of overdose, so to speak, of put positions, right? This whole year, again, has been large put positions. After basically that January expiration has been completely put positions. There was a brief respite in August, as I mentioned before, but otherwise it's been very large put positions. And again, as I stated, that drives volatility. If the VIX goes up, that tells us in general that put positions are gaining in value. Dealers got to hedge even more. If the VIX comes down, dealers got to start buying back futures. That causes the market to rally, which means dealers need to buy back more futures. It creates these feedback loops. Some people will call it reflexivity, where you have to react sort of to the reaction, right? And these feedback loops seem to spool up or continue into options expiration. Then big positions expire and it kind of resets the loop. That's kind of a little bit what you're seeing with this chart. The other reason I want to talk about that volatility is let's look at realized volatility. So for those of you who aren't familiar with realized volatility, what realized volatility does is it measures how much movement has occurred in the market. If you go to the S&P global page, you can get this chart of 1 month realized volatility. So this is a rolling window of, I believe, 20 days. It may be 30, depending on their metric, but it's 1 month realized volatility. So how much has the market moved over the rolling last 30 days? And as you can see on this chart, our current measure of realized volatility is sustained at a level that is higher than it's been in the last 10 years. There are a few episodic crashes, obviously, Volmageddon in August of 2015, certainly 2020, you get these spikes, right, of realized volatility where VIX goes over 40 and kind of all heck breaks loose. We've not had that blow off VIX top yet, right, or capitulation type move. I think most of us would agree with that statement. But what we have had is this just unrelenting volatility. And what you can see is this volatility actually started late last year. And this is the same time where we saw two things happen. One, people started to add put positions in a material way. I have a chart that I can show on that. And then the second thing is kind of unrelated, but it's pretty interesting. You could see liquidity in the E-mini S&Ps really start to dry up. And what this is all related to, and what I want to sort of posit here, again, this is sort of a macro piece, but just something to think about. The Fed started to talk about raising rates around September, October of last year, right? They let it be known that this was something they were going to start doing, and that their path was to start sort of tightening. And it's clear that big funds and sort of smart money, I would say, got that message and started to sell early in this year. And I think that is a major reason why we are having these big bouts of realized volatility. The other thing to note here is if you think about all these market crashes, right? December, this was the Volmageddon, which I would argue is not necessarily an episodic crash that the Fed wants to get involved with. But if you look at the 2018 crash, March of 2020 for sure, and most of the other episodes where we've had any kind of, anywhere between discomfort and sort of real fear in the markets, the Fed has always come out and said, we got your back. Here's some quantitative easing. Here's some better rates, right? The Fed put was in place. This is the first year that the Fed put is not there, right? And it's a completely different volatility landscape. So that's kind of some food for thought. So let's shift, right, to looking at the VIX. A lot of people ask, is the VIX high or low? Is it expensive or cheap? What should you think about it? So for those of you who are unfamiliar with what the VIX is a measurement of implied volatility in the S&P 500. And what it does is it looks at the implied volatility for all options in the S&P 500 that expire within 30 days. So in a way, it is a 30-day volatility metric on the S&P 500. If you look at the VIX price, right, which is 30 days forward looking, and you subtract realized volatility in the S&P 500, which is 30 days backwards looking, you can get a spread, which is pretty interesting. So that's what this chart is. I literally took the price of the VIX and the price of 1 month realized volatility, which is currently around 25. It's probably just a touch higher now with the volatility of the last few days, but I just subtracted those two and you get a spread. And what you'll notice is going back to 2012, there's a pretty consistent average here, right? Wherein the VIX tends to trade at a slight premium to realized volatility. And that makes sense because in general, your baseline for how volatile you think an asset's going to be is how volatile has it been, right? How much volatility do I think is going to occur in the next 30 days? Well, what has it been doing? There are a few times where that changes, and that's generally after, and you can see these negative kind of spikes, where there's been a big market crash, right? And people go, okay, oh, look, March 2020, Fed just rolled out huge quantitative easing. They got our back, right? We're not going to continue with VIX levels of 100. So traders will start to sell implied volatility or future volatility, right? But realize still has that big crash, right, in its window. So that's why you get these, big drawdowns, so to speak, in this metric. But what I want to sort of jump to is this conclusion here is that if you look at where we are right now in this spread, it's kind of in the middle, certainly, not high. I wouldn't call it low. It's just kind of average. So what this says to me is like, look, the VIX is fairly priced based on what realized volatility is doing. Now, this is with the VIX a little bit closer to 25. Obviously, our VIX is 30 here, but realized vol has been a little bit higher. In other words, we're getting a little bit more movement here. We don't have this market that is looking at a spread of like this, right, where the VIX is significantly over realized volatility, which would indicate that there is real fear in the market, right? That people have this demand for tail risk, or they're concerned about, really concerned about the future of the markets. You could argue that over the last 2-3 days, that has really changed, changed a little bit at least with the VIX at 32. But this chart was put together in the beginning of September, and so you could see that there was this idea of just fairly valued VIX. We talked about, event volatility for the FOMC. I left this chart in just to give you an idea of what I was talking about, the volatility impact. In general, kind of gun to head, what I would say is that anytime you have the FOMC, people own put protection, right? Or they own volatility, they're long volatility because they're not sure what the Fed is going to say. And so this dotted line tells you what volatility was before the FOMC. And then this bottom line, this is terms, this is the skew, so to speak, for on the day before FOMC, right? So this is the 3,800. These are the 3,800 puts that were set to expire on 9/22, and I took this snapshot on the 20th, right? And then the next day I took the snapshot after the FOMC, and you can see that same expiration, that skew just deflated, right? That's implied volatility coming down, which generally supports asset prices, generally supports markets, I should say. So this gives you an idea of what we call event volatility tied to things like the FOMC or even earnings, right? In earnings, you get a similar thing where that implied vol really drops down, and that can lead to a change in hedging dynamics. So that one aside, I wanted to bring up this chart. Many of you have been watching things over the last day here. You have this situation where the MOVE index, which is the bond VIX, the MOVE index measures the implied volatility of treasury options. So it's very similar to the VIX in the equity options. It means the same thing. If you're unsure of how treasury bonds are going to move, you're going to pay a higher price for options. And that's reflected in the MOVE index. The MOVE index actually has jumped higher over the last 2-3 days. So what we have now is a ton of uncertainty in the credit markets. And we have what I would say is sort of languishing equity volatility, right? Think about this chart again. There's not a big premium to this. It's sort of just average. And so we have this big chasm, right, between the MOVE index and credit volatility and the vol complex itself. And so the reason that is a concern, in my view, is that if traders aren't long put protection now, right, in mass, and certainly after September expiration, there's not a big, there doesn't appear to be large put positions until December of 2022. There's big put positions at the end of that month. If we're sort of weak in this market and and demand for put options comes in, right? When people start to buy puts, dealers are short puts, they need to start selling more futures. And if the VIX and all of these equity risk measures start to pop up, like the skew index or VVIX, right? Those both are measurements, so to speak, of tail risk of major moves down in the market. So if we get some action there, or the VIX spikes higher, i.e. implied volatility jumps, you'd have put buyers into jumping implied volatility. Both of those imply that dealers have to start selling a lot of futures, right? And that could really cascade. Those are the types of things that lead to, limit down type market movements. So, in our view, when you sit here and you look at the ramifications of all these put positions, right? There's high volatility in the market. There are, puts are controlling how things are moving with the volatility whipping around. And then you have this sort of chasm or link between bond volatility and equity volatility that's not quite syncing up. I've been talking about this chart a lot. If you go to our YouTube channel, youtube.com/SpotGamma, we talk about the bond VIX and some of the risks associated with that. But I flash this up too, because if you look at that positional analysis, you see, okay, people start to really want to demand downside hedges, which would make VVIX and skew index and all that spike higher, implied vol and option spike higher. That could really add, some more trouble to the market. And so I will take a few questions here. I just wanted to talk about the current situation, very quickly. In our daily notes, we've been talking a lot about September 30th expiration. There's a large put position there tied to the JP Morgan quarterly roll. They have a collar trade on. You should just kind of Google JP Morgan quarterly roll. We have some articles about it and a video on our YouTube channel. But basically what this big fund does is they sell an out-of-the-money call every quarter, and they use that to buy a put spread. And so what's interesting is they have 45,000 puts that expire this Friday at the 35.80 strike. And as the market slides lower, that implies that dealers will need to sell the delta here is about $1 billion for every roughly percent in the market. So this is a big position driving the markets into Friday, right? This is the quarter of the expiration where these things expire and are rolled. So this is the type of position analysis that we're talking about, that, as you know, gamma is highest for at-the-money options. And so, the delta here is fairly light, but as we get lower and that gamma picks up, that tells us that the delta is getting bigger, obviously, right? The gamma is adding to those deltas, and you can end up with a pretty interesting short-term low around 3,600 and Friday, where this put position is set to expire, and that could release some of the short-term pressure that we see here. So I'm happy to take a few questions here. I hope I didn't jump around too much on this, and if I sort of skipped over some of the key metrics or some things to talk about, please let me know, and I'm more than happy to go back on that. Paul B asked, does the option strike also affect the option price? The strike sort of tells you how far an option is in or out of the money. And so, I don't think the strike itself is material, but really what matters is how far out of the money is that option. Delta is also regarded as not just a hedge ratio. So, if I have a call that is a 50 delta, that tells me that I need to buy or sell 50 shares of stock to hedge that position. But if it has a 50 delta, some people also read that as a 50% probability that the option expires in the money. So, that I would say the strike doesn't matter as much as how far out of the money something is. Raheem asks, I'm curious if I've heard of Payne Theory. I'll tell you what. So Max Payne theory looks at the open interest in the market, right? And it tries to estimate sort of the theory is that dealers and market makers are going to shift the market to where sort of the max pain for the market is. So if you have a whole bunch of, let's say, puts expiring and a whole bunch of calls expiring, let's say out of the money puts and out of the money calls, Max Payne would say we're gonna move the market right to where all of those calls and all of those puts expire. My problem with Max Payne is that it's an open interest metric. And open interest can be very noisy. You could have call positions or put positions that are significantly out of the money, right? That are just sort of meaningless to the market. Whereas the reason that we gamma weight everything, so when we look at open interest, like on your chart here, what you're seeing is we look at open interest and we multiply that by gamma, basically, the gamma for each contract. And that, in theory, tells us the notional hedging size that's at each strike. And this is for all expirations. So you can see that these are all put positions on the bottom, right? And call positions at the top. Obviously, we're dominated by put positions at the moment. The fact that these bars are so big and negative tells us that there's a lot more negative gamma associated with those puts than there is, gamma for these calls. But the point is that gamma is a weighting mechanism for how important an option position is to the market. Gamma is highest for at the money options, and as we get closer in time, and it tells us the sensitivity to hedging pressure. So the more gamma an option has, the more in theory it has to be hedged, and the more that we care through a positional analysis lens, the more that we care about or think that option is impactful. So for that reason, I personally don't look a lot at Max Payne. Some people find success with it. More power to you, but for me, I tend to discount that theory a little bit more. So those are the three questions. Don or anybody else, I don't know if it's easier for someone to talk and ask a question. I'm happy to field some questions that way.
Okay, I got a quick question. Well, first of all, we should be fair to you because I know you're going to have to run fairly soon. Do you want to mention which of your products or services people here might be able to use?
Oh, yeah, sure. So depending on what you like to look at in the market, I guess we have a couple of different ways. So just to give you an idea of what our daily note looks like, this is the note that we wrote this morning. We have our key levels in the S&P 500 and the NASDAQ. And basically, we have a lot of people who are options traders. They want to structure, butterflies or call spreads around these levels. Or we have a lot of traders that are also futures or spider traders, right? They don't trade options, but they want to know where the big options levels are, right? Where dealers are likely to act. So we lay out these key levels. We lay out our macro themes. Today's big note was about obviously this JP Morgan collar position that I mentioned. And we just walk people through the mechanics of what we are seeing. There's been a lot of information today, about record put volumes. And I don't know if any of you caught any of that discussion, mainly on FinTwit probably. But what's so fascinating as a side note here was that we thought that people saying there's record put volume, that it was significant to sort of where we stood in the market in terms of a high or a low. Some people saying, well, a lot of those puts were closed and the bottom is in, and other people are saying, get your crash shoot on. And our point was that 70% of the volume from Friday for that record spider volume day took place in expirations that had 7 days or less to expiration, right? So people are just trading weekly options like crazy, and that skews, we think, some of the value of saying record puts, right? Because all those puts are essentially being day traded. So we covered different things like that in our notes. You can also go into what we call our equity hub. And our equity hub allows you to look at the options positions or key options positions in over 3,500 different stocks. And it allows you to see a whole bunch of different metrics in there that are both positional metrics, sort of like where big deltas are, how much is expiring, right? We see stocks shift around expirations as we noticed. You can also look at some different skew metrics. How is option skew changing? Is skew inverted, right? If skew is inverted, that can be interesting to traders because that tells you that out of the money calls are bid up. That could be an interesting opportunity to play like a gamma squeeze, for example, or maybe you want to sell that elevated implied volatility. So you can get different information like that from here. And then our sort of premier product is called Hero, and that is on your screen here. And what Hero does is it looks at the hedging impact in real time of all the options being traded. So, excuse me, again, if you are looking at your chart on your screen, what we do is every single trade that takes place in spider options, we are measuring the delta of that. And plotting it on your screen. So that is the purple line, right? So to start the day, people were buying calls and or selling puts as the market opened. Buying calls is a positive delta trade. Selling puts is a positive delta trade. So we think dealers would have to buy stock. Here that flow flips. Looks like people start buying puts and selling calls, and you get sort of the in and outs and see how this options flow, right, can possibly impact the underlying stock. So we offer this hero product for over 170 stocks right now, and that list is continuing to grow. And for any of you that are interested, if you hit subscribe now, there's a free 7-day trial. So you can try it out for 7 days. If you like it, great. If not, you go to SpotGamma.com and you just hit your account right here, and then you just click cancel. Not that you want to, but if you do, you can just cancel from the page. So it's very painless, and we want to make sure everyone has a good look, right? A free shot to know if this is a value for you and your trading.
Yeah, that's great. And you have quite a lot. Do you have enough in your Twitter feed for people to get a flavor of it?
Yeah. So our Twitter feed is probably where we discuss the most. We talked a lot about this options positioning. There was a big video that we put out that got quite a good response here about record put buying that some of this OCC data put out. So we broke down what that meant. It turns out that if you look at the data, yes, there was record put buying, but there's also record put selling at the same time. And so there's another gentleman, he put out this record put buying chart and left out the fact that there was also record put selling. So the two kind of net out. So we cover a lot of those things on our Twitter feed. We're just at SpotGamma on Twitter. I try my best to answer DMs on there, direct messages. But you can also reach us at support@spotgamma.com, and we do our best to respond to any questions. We also have something called the Academy. So if you go to academy.spotgamma.com, you can get to it from our main page as well. But we have a gentleman named Imran Laka, and he teaches you everything you need to know about options, from like what is a call and what is a put, all the way up to sort of what vol hedging is and skew and all that. We worked with Imran because he's based out of London, but he designed courses, and his primary role was to give training to the incoming recruits at all of the derivatives desks in London. So, the institutional banks. So these are sort of like the college kids that are coming in and need to learn how to trade, right? He's responsible for giving them training. And so we just said, hey, you already got a great course. If this is good enough for banks, then it's great for all of us, right? All of us retail guys like myself who want to just learn how to use these concepts to improve our personal trading. So that's just another one of the offerings.
I see we have a question here. Any discounts to buy SpotGamma service? And I should mention that Matt Fox, who's
Matt is
very important person in your company, said that we could have a 2-week free trial. So I guess that's a replacement for 1 week by using the code R. Let me find it here. RD Trader. So if you sign up, you get he says it's $50. You can 2-week free trial. And I guess I'll ask you one question. I know you have to go. And you're adding a lot of insights. Maybe that could be considered alpha in some way. Is there a risk that these insights will be arbitraged out of the market at some point?
It's a very good question, and I would say two things. One, the size of the options market is increasing at the moment, and it seems to be increasing with shorter term flow, which is quite interesting. So the dynamics of the way that things are working is changing, but the fact that the options market is growing in size, I think actually strengthens our case. The second thing I would say is that the fundamental sort of purpose of an options market maker, right, is to hedge their deltas and to be somewhat risk agnostic, right? And so unless they sort of change the way that they're behaving, then we still think that this focus has, or this positional analysis still has a lot of merit, right?
It could well be the case, because after all, we still have the perpetual premium of implied volatility over realized volatility that has existed for a long time. So hopefully yours can do so even more so.
Yeah, and I would say, thank you for that question. Obviously, I wanted to show one last chart here, which I just want to put the other options expirations in context. So if we happen to not speak again, I do have one interesting chart for everyone to look at. I mentioned the December options expiration. I actually have a sneaking suspicion that, you know, we could have like a 2018 kind of tricky market here over the next, you know, end of the year. And so this is the options expiration as of a couple of days ago here. And what I wanted to focus on is that this is that JP Morgan collar trade, right? This delta has grown a bit in size after obviously the market slid down, but you can see how big this December expiration is. So, you know, we have the October expiration monthly, which is of decent size, but this December expiration always tends to be a monster. If you remember 2018, you know, there was the famous Christmas Eve market crash, which was the day after a very large options expiration, and Mnuchin, you know, called the banks. There's a bunch of headlines about that, and the market bottomed midday and rallied. And there's this weird phenomenon where the market tends to rally. It's starting at noon the day after these big options expirations. And so, you know, I think if you end up in a situation where you see the market kind of cascading into the end of December, into this end of December options expiration, I would be on the lookout to try to find some options trades that express some positive deltas, right? That could maybe make some money in a rally, in that type of situation. So just some food for thought.
It's very generous of you. I know you have to run. You've already gone over the time that perhaps you have. So I think it's a fantastic thing that people can learn a lot from. Thank you very much for your time.
Thank you all for your time as well. And again, any questions, you know, please reach out to us, support@spotgamma.com, or send me a message on Twitter.
Fantastic. Thank you. We'll continue. We'll take a little retrospective look at some of what you said, I think.
Okay.
But we'll let you go. Thank you so much.
Sure. And I love any feedback on any of these concepts as well. I'm always open to discourse.
Sure will. Thank you very much.
Thank you all.
See you. Bye. Okay, we will continue a little bit. And okay. Yeah, on that offer, let me just show it to you. Let me see if I can share this for you. Share. I think I wonder, well, do we want to start recording or not? Let me think about this. Let's stop the recording. I'm going to stop. Well, yeah, let's stop the recording.